Hey, how's it going, guys? It's Andre again, back at it with another video. Today we're going to be learning more about false formations, like how retails get stopped out when they get in for buying or selling positions. When they start seeing these formations like double tops, double bottoms, head and shoulders, and reverse head and shoulders, right? But now, before I get started into that, I do want to mention that if you guys click the link in my bio, that'll shoot you guys over to my Telegram group where you get to join live sessions with me every day from Monday to Thursday, doing London sessions and taking live trades and learning live education as well. And there you could also ask any live questions that you want with me, and we could personalize personal one-on-one mentorships as well. So yes, go ahead and click the link in bio and put those thumbs up, and we'll get started with this video right now. Okay, so first of all, what we want to go ahead and do, I want to go ahead and explain to you guys how retail traders start looking for double tops, double bottoms, head and shoulders, and so on when they're getting for buying positions or selling positions, right? So let's create this example. So let's start making a double top formation. So start making this double top formation. So in a double top, it's always going to be like an M formation, or it could either be like a W formation for a double bottom. That's where retail traders get in for buying and selling positions. So here we have the famous double top, right? So what do retail traders look for in this perspective? So they see right here that market has a double top formation. So we have the first top, which is this one right here. Then we have the second top, which is this one right here. Now, usually retail traders, they start getting for selling positions when they see a double top right on the second top. Why? Because they see an equal resistance. So they see what's respected in the past or respected in the future. So thereon, they're going to start getting for selling positions in this area. So what's going to happen is the market is going to come down and break the famous neckline that they aim for always. So they have the neckline. They always want to wait for that break of neckline so that way they could get in for more selling positions later down the road, right? But in an institutional aspect, what's going to actually happen, market is going to go ahead, break that neckline. So retail traders mentally, they're already going to be in profit. So what's going to happen with retail traders? They're going to tend to move their stop losses to a risk-free trade. So now they will be having their stop losses right here. So right here we'll be having the stop losses from retail traders, right? So we have stop loss from retail traders right on those equal tops, which is the double tops that we have right here. There's two tops right there. So what's going to happen? They're going to be in profits because they broke neckline. So they say, okay, let's launch that trade more. Let's see how much more far down we could go. Yes, it is going to go more far down. But in an institutional aspect, what's going to happen is now that down here, market's not going to be down here. But in the past, for institutional aspects, we are going to be looking for what we call an accumulation of price candle around this range. So accumulation of price candle, we could go over that in a different video so that you guys can understand what that is. Maybe I'll go over that in the next video after this one so that you guys can know how to do accumulation of price candles and find specific sniper entries in those areas. So we're going to tend to have an accumulation of price candle right here. So accumulation of price candle is always going to be the last bearish candle before the drastic push to the upside, which we had right here. So let's say that this is the bearish candle, and the push up right now is going all this, which is just the whole push up right here. Let's see, let's point that out. So the whole push up would be this whole rally to the upside, this whole rally up right here, this whole rally. So that'll be the push up. So what we're going to be waiting for is for market to come back down and retest right on the accumulation of price candle that I have pointing out right here, which this right here is going to be accumulation price candle. So the accumulation of price candle right there, which is the last bearish candle before the push up. It could also be the last bullish candle before the push down. So institutional aspect, institutional traders are now getting in for buying positions here. To do what? To spike all the way up and wipe out what we have, the equal tops. Why equal tops? Because right there we have stop losses, guys. We have stop losses right there that want to be cleared out. So the base are just getting for drastic push to the upside, so that way we can start clearing out the stops that we have right there. So before we even start going all the way up there, there's still a bit more retail aspects to go to, right? So retail traders, they're going to wait for their normal retracements to come up here because they want to get in for more selling positions right here, right? So they want to get in for more selling positions right there, so that way we have that tap over here. So we have the normal retail perspective of support resistance, neckline, blah, blah, and so on. So they get in for sales, right? Yeah, it could be some short sales, But what they didn't know is that we're going to have another accumulation of price candle around this area, because right here we had a drastic push up before on the last bearish candle, right? So the market's going to still come down a bit more. After that, so with retail traders are still in profits, so they're going to get market's going to come down here and just come and test the last accumulation price candle that we have right here for that drastic push to the upside, which now will be going up to see. Now we can start clearing out stop losses going up. So market's just going to spike all the way up, clearing out all the stops that we have right here. So that is what we'll be waiting for on a institutional aspect of trading, right? So for institutional to work, we have to wait for all the retail traders to get in first, so that they can start moving their stop losses to break even and so on. And that's when we get in as institutional traders with those big moves in the market, those market maker moves, you know, guys. So that's where we want to get in for buying positions. So I'm gonna just go ahead and put this example into what is a live chart example, so that way you guys could see how this is, right? So I'm gonna just leave that drawing there so we can go back to it after we see the live example. But let's go back to the chart. Let's see. Let's start looking for a double top, double top formation, right? So I want to start looking for a double top in the live market that actually had already happened. So that way you guys can see a quick example of what I'm talking about. So let's just trace back to the market. Let's start looking for a double top formation, because those are the false formations that we always are going to be wanting to look for. Because those are false formations that we want to get in and take advantage of and clear out all the retail traders out, right? So let's see. You start looking for a double top. Let's go more in the market. Okay. Boom. Right here. Right, we actually have a great example. We have a first top right here. We have the second top. And then we got the neckline, which is this right here, right? So retail perspective, what's going to happen? Market retail traders are getting in for sales here and getting in for sales here once again, because right here we have the test of that neckline, right? So now market's going to push all the way down to this area to come and look for an accumulation of price candle. Yeah, maybe right here you say, yo, Andre, I don't see an accumulation of price candle. No worries. That's why you got to go to a lower time frame to try and look for that accumulation of price. So let's go to the 15-minute. Let's try to look for that accumulation of price candle on the 15 minutes. So let's just go back to where we were. Just go all the way back over here. Let's see. So it has to be over here. Just going back to that double top that we had traced. Okay. It's a bit more back. Yeah, another double top was pretty far back. All right, here we have it. Boom. What do we have here? We have our last bearish candle before the drastic push up. So we look closely right here. This candle right here is accumulation price candle. Why? Because this is the last bearish candle that we had before the drastic push to the upside right here. So it started pushing up and just drastically went to the upside. Then what's going to happen? Market's going to come all the way down, come and retrace to that accumulation of price candle. And this is where us as institutional banks, we want to get in for buying positions and take advantage of this whole big move to the upside. This move to the upside is just going to keep on going all the way up to clear out the equal tops that we have here. Now, what happened? We guys see, we could have gotten in for a buy here. Let's say we got in for a buy right there, right? I would have gotten my long position tool, got in my buy right there. Now my stop loss, I am always going to put it 10 to 15 pips below or above the accumulation of price candle. It's going to be below when we're going for buys, and it's going to be above when we're going for sales. We have the accumulation of price candle here, so 10 to 15 pips. Let's see. Let's put it 12 pips, okay? So that's going to be our stop loss, 12 pips below the accumulation. So this is just the stop loss. So my stop loss would have been 20 pips to gain a total where we have the equal tops right there to have that wiped out. A total of 70 pips. So we're risking 20 to gain 70 pips on this trade, right? So that would have been the take profit that we would have had. As you can see, we had zero drawdown. Like these entries, you guys, are pretty precise. So they're super precise and super accurate when it comes to this strategy and institutional trading, right? So this is just one of the a lot of false formation that we have, which is the double top false formation. So after that, we also have, well, obviously the double bottom false formation, right? So double bottom is going to be the same perspective, same thing, just the opposite direction. So we have the drawing here. Yes, we see that this right here is just exactly how a double top that we had. Double bottom, it's going to work the same thing, same concept, everything. You're going to wait for the tap of the accumulation price candle to get in for that sale, and so on, right? So now I start looking for a double bottom false formation. So we had the double top. Now let's look for a double bottom false formation. Let's see if we find that, right? So let's see, guys. Start looking for the double bottom. Where do we have a double bottom, guys? So right here, we actually have a double bottom right here perfectly. Watch. Look at this, guys. So we have the first bottom. We got the second bottom, the W formation. And then we have what? We have our neckline. So this is a matter of just being patient all the way, you know, because retail traders, they're getting for buys here, they're getting for buys here. So currently right now, retail perspective, when they got in for a buy right here in this area, well, they were already running 115 pips in profits. So like psychologically, you're going to want to move your stop loss to break even, right? Because you don't want to lose this profits no more. So retail traders are going to move their stop losses where? To their entry prices, break even, right there. And retail traders also got in for buying positions on the neckline. Why? Because of the retail trader perspective. So they got in for a buy right here again, which their buying position was right here. Now, are we getting in on buys with them? No, we're not. We're being patient. We're waiting for that big move to happen, right? Because why? After that, market's going to retrace all the way up to what? It's accumulation of price candle that we have back here. Boom. There we have it, which is our last bullish candle right there before the drastic move to the downside. What is market going to do? It's going to retrace all the way back up to that area to then start getting in for selling positions and clear out all the retail traders. So right here, we could have got in for the sale right here. Right when we saw that tap, after we saw the false formation happen, our selling position, getting for short, would have been exactly right there. Now, where's our stop loss? Our stop, like I said, it's going to be 10 to 15 pips now above our accumulation price candle, which would be right here, 10 to 15 pips, right there. It's going to be 18 on this one, in this case. Boom. So my stop loss would have been 26 pips. Where's my take probably going to be on my equal lows, my double bottoms. Why? Because we have stop losses that could be stopped out. So we're risking 25, 26 to get a total amount of 144 pips. You guys can see market perfectly went all the way down there to clear out the stop losses that we had down here of retail traders. And our drawdown was around, I'll say we did not have even a big drawdown at all. Now our entry price was right there. We would have only had a drawdown of 8 pips. There you have it, guys. So that would have been a super good entry that we would have had right there institutional wise. So that is what we know about false formations. I mean, there's also the same concept like when it comes to like false head and shoulders, false reverse head and shoulders, and so on, which we could actually go ahead and look for some examples as well. So the head and shoulder ones, well, it's just like I'll show you guys how it looks like on a drawing. So we have the normal head and shoulders formation, which is the left shoulder, the head, and then you have the right shoulder, right? Then you have the inverted head and shoulders, which is left shoulder, the head, then you have the right shoulder. So retail traders are getting in for buys on the reverse head and shoulders, and they're getting for sells on the head and shoulder formation, right? So they're getting for a sale right here on the last shoulder because that's their last confirmation, which that right there is where we have our stop losses. So right there we have our stop losses. Why? Because we have the equal highs. And then over here we have stop loss too as well. Because why? We have the equal lows. Why? Because the retail traders got in for buys here, and they got in for sales over here. They also tend to put their buying positions or on the head formations, and they also tend to put their selling positions on the head formations over here, right? So what we wait for as institutional is for market on a normal head and shoulders to keep us spiking down, look for its accumulation of price candles, then spike all the way up and clear out the stop loss that we would have right here and would have right here. Same thing, that's our reverse head and shoulder. Retail's getting in for buys here, getting in for buys here. So what we wait for is for market to keep on rising and look for its accumulation of price candle. So we could have this drastic drop, clearing out the stop losses of the right here and stop losses over here, which we'll go right in detail into that right now. Let's start looking for some head and shoulder formations or some false head and shoulder formations. Actually, right here, perfectly, we could see it. We could see one right here, which we have the left shoulder, we have the head, and we have the right shoulder. Same thing, same concept. What happened? Market rise to the upside. It broke the neckline right here of the reverse head and shoulder. It found this accumulation of price candle right there. Market tap came in. So we would have got in for a selling position around this area. Our take profit would have been all the way down here, clear out the equal lows of the shoulders. And then it came all the way down to clear out what? Clear out the head right here, boom. And then instantly got rejected and started going up. So right there would have been our take profit, right? So now let's look for a normal head and shoulders. Let's see if we find one. Let's see. So we find one. So we are looking for a normal head and shoulders, right? So right here we actually have one. Watch, look at this, guys. We have the left shoulder, we have the head, and we have the right shoulder. What do we wait for? We wait for market to break that neckline that we have right here, keep on spiking down to look for its accumulation of price candle, which we actually did right here. This is where market got rejected, which we're most likely, I believe so, that this would have been the 4-hour accumulation of price candle. So let me just rewind this. Let's go back over here. Where was it? Yeah, right here. Boom. So right here we have the rejection, and right here we see market coming down to that bearish candle before the rise up, which is the last bearish candle right there. That right there is the accumulation of price candle. So right here, we could have got in for what it is a buying position on this area. So got in for a long position right here. My stop loss, like I said, it's always going to be 10 to 15 pips below accumulation, so 10 to 15. My stop loss would have been right there, would have been 12 pip stop. I mean, this would have been 53 pip stop loss. Now, my first take profit, where would my take profit be? It's going to be going back to the 1 hour, so I can look at that formation. My take profit is going to be where? It's going to be on my head and shoulders to clear out the stops, which will be all the way up here where we have the wicks. Why? Because that's where all the stop losses are of retail traders. So we already had a total of risking 53 pips in this case, like 50 pips, to get a total of 157 pips. But you guys can see zero drawdown. You guys can see zero drawdown. So entry super precise. Like nearly when it comes to institutional trading, you are never gonna have drawdown. You will have drawdown, but the drawdown will be like a max of 20 pips max if there was to be drawdown. But it tends to never hit stop loss, you know. So I mean, drawdowns are very, very good on this type of trading when it comes to institutional trading. So I mean, that's what we look for false formations. We always want to wait for retail traders to be stopped out. So we don't trade with retail traders. We trade with the banks. We trade with those big hedge funds, right? So we want to be making those money moves, right? So those quick moves up, those big pushes, the market makers. So what we are market makers, right? We're trading with the banks. We're trading with the smart money. So this right here is how you identify false formations. I hope this video helped you guys a lot. And like I said, go ahead and click the link in bio right there. You could see and join my Telegram group where I go live with my students from Monday to Thursday and go over every single pair that I go to. And we take live trades as well. And I also answer questions. So I do Q&As there as well if you have any questions. So yeah, just go ahead and join, and I'll see you guys in the next video.